This strategy, by the way, was born off of the emotions of trading, the greed, fear, hope, and despair area that we put ourselves into so many times. And, you might wonder, well, why cash flow? Because it has its pluses and it has its minuses. Why venture down this area? For me, I think it's different for each person. For me, I'm at the stage in my life where I don't like the short-term trades as much as I like the long-term trades. I'm in a stage of my life where that thing behind me is muted most of the time. I don't hear what's going on in the news. I don't listen and look at news as much as I used to. I did watch the State of the Union last night because that's a once-a-year thing. But other than that, I don't. It's funny. Trump talked so long last night. I don't think a lot of people stayed up to watch the response, the Democratic response. I almost feel like that was part of his MO. If I talk for long enough, what was it, 2 hours? If I go on long enough, people are going to get tired and they're not going to want to hear the Democratic response. That's just my opinion. Anyway, I'm not a big newsy guy as much as, and I've also realized, and I realized this long ago, but it gets confirmed to me every single day that, if you're trading off of emotions, or you're trading off the minute-to-minute news, that's just an area that, it's a slippery slope you don't want to go down because it doesn't often work out. And so, it's funny. I have Jay told me, hey, you got to bring this up and show this to everybody on what it is that you're doing. And it has a lot to do with the core strategy. And so I'm going to share the core strategy with you, and then I'm going to share an email that came in recently from someone who has been following this method and actually did the last cash flow program with me that we did last year. And I want to share with you how they performed, how they did in the last 6 months of last year, because that's when they started, and then they kind of reported to us. So not only me, but in what we see, but it's nice to see the students that are out there that are doing this too, and to get back a long letter like we did was very refreshing. It just confirms to me that not only do I like the strategy, but it's teachable. The stuff that we have is teachable, and people are able to grab that and go with it. What do we not do? Like I said, I'm not a meme trader. I'm not a day trader. I used to trade a lot of short-term stuff. I trade very little short-term stuff. Maybe every once in a while, I'll jump into the holiday pattern, and that's a 1 to 2 week pattern. But that's as short as I get. If I'm a short-term trader, it's because I'm getting out of something that matured faster than the expiration dates that I had on. All right. I find that, when you get to this point, this type of trading strategy where you're looking at high probability events, opportunity all of a sudden becomes everywhere. This is a strategy that I started teaching after COVID, because if you take a look at 2020, 2021, 2022, 2023, you go and you look at what's happened in the last 5-6 years, we've had every single one of these occur. We had the volatility, the big volatile move in 2020. We had an uptrending move that happened in 2021 and part of 2022. We started downtrending in 2022 and 2023. And if you take a look at what's going on here recently, especially with the S&P's moved sideways. You can draw a line across the highs of October. Yeah. And the lows that happened, just yesterday or the day before yesterday, and we're pretty much in the same area. The market's kind of, just gone sideways. So we've seen all of these setups occur, and it brings me back to the point that opportunity is everywhere when you have the right strategy and you know where to look. So those of you that are brand new, okay, that are new to this particular portion of this event for week 1 is really for you. Okay, it really is for you. So I want to talk about option basics, and then I want to bend it into what we do. All right, what we do as premium sellers. So again, and I'm not going to get into this part into some long event, but what is an option? It's a contract between a buyer and seller. The buyer of the option has the right, the seller is obligated. Okay, think about real estate. So Jay knows this, and a few of you know this, but my daughter's a real estate broker, and she's a young real estate broker, but she's finally getting some success. I got to say, the real estate industry, that is a hard industry to break into because, here in Florida, you've got older, seasoned realtors that are, they're known in the industry. And breaking into this business, into the real estate business, I think is as hard as any business to get into. You get no upfront pay. You got to jump through a lot of hoops in terms of passing different accreditations. And you're in Florida. Think about this. Where I live, what's the average age in Florida? Probably me. All right. Yeah. I mean, we got young people down here too, but I'm on the west side of Florida, in the Sarasota area. And it's a hard one to break into. And Perry, you're right. You got to build a clientele. So my daughter, who is in her 20s, is a real estate broker competing with people that are 2 and 3 times her age. And did a different spin. She does Instagram, and she does different, like, reels is what they call them, or shorts, YouTube shorts. And she will walk through a home and do a quick, like, 30-second piece on the home really quick. What do you think about it? Check out the full view, click here. So she's using the tools of today, competing with the real estate brokers of yesterday. But to turn it all back around, when she does a transaction, you've got a buyer and a seller. She's either represents one or the other, but sometimes she represents both. She's, in a sense, almost like a market maker between a buyer and a seller in some cases. And so the buyer has rights, the seller obligations. What that means is this. Let's say that she is selling, she's representing a property out on, Anna Marie Island. Okay, Anna Marie Island is at the very tip of a chain of islands right above Sarasota. Is a very expensive area to live, but also it sticks out there on Bean Point, which is at the very top of Anna Marie Island, which is some of the most beautiful sand. But also, you're sitting out there. You're the first defense when a hurricane comes. So let's say that the buyer enters a contract. Seller's excited. They're getting to sell the house. The buyer puts down their deposit. Let's say they put down 10 grand to go to closing. And let's say for some reason, either the inspection they're not happy with, or the hurricane comes through before close. They can back off the contract. They might lose their deposit, but that's their right to walk away, right? The house that I currently live in, right? I was trolling this house for months. It's an older home. It's not brand new. It was a remodel, but I like the bones. I like the concrete. And so by the time we got a chance to get a good look at it, it was under contract. It was under contract, and it stayed under contract for 5 months. And I see it again. On Zillow, I'm looking at it again. I'm like, why didn't this house sell? So I ended up calling a real estate broker, and turned out the buyer could not get financing. So the buyer lost his and her right. The seller was obligated. If the buyer came to the table and closed, the seller was obligated to close at the price. So anyway, seller lost the right. I step in. I write my option contract to buy the house, right? I closed in 30 days because I bought down the house. I didn't want my negotiated price was well below the last person, but they were ready to sell. They couldn't sit on it because they had debt too, because this was a builder that had debt. And so the builder wanted that debt off their books. So they lowered the price. So pretty nice discount. So we picked the house up, but we went through and exercised our right to purchase the house. The seller might have said, wow, did we price this thing too low? Because he snapped all over it as soon as we gave him the price we were looking at. They couldn't change it. Once we went to contract, they were obligated. And I want you to think about that with options, with stock options. Those are new, okay? Maybe you think, like me and like everyone else that enters the option community, it's just like a stock, but it's cheaper. That is the furthest thing from the truth. That might be the first sliver. It's just like a stock, but cheaper. But here's the problem with that statement. There are 3 dimensions to options, and price is only one. And that's why most people lose money trading options, at least in the first year. I think it's the first year, first 18 months. You can clear out 90% of option traders. It's this constant, constant turnover. New ones coming in, always leaving. All right. Then some of the old ones get recapitalized and come back in again. And so the thing is that, you can beat yourself over the head like that, or you can learn to do this, realizing that you're not going to be right 100% of the time. You got to treat this more like a business. So calls give us the right, but not the obligation to buy a specific stock. And then puts would be the reverse. If you're looking to either speculate to the downside, if you buy a put, gives you the right, but not the obligation. All right. So stop right there for a minute. So this is not what we're doing here today or for the next 4 weeks, right? We're not going to be on the buy side. And there's a good reason why we're not going to be on the buy side. I'm going to get to that in just a moment. For those of you that are new to options, again, you might, some of you in here are like, Tom, I've been trading options with you. I got grandkids now that I didn't have when I started with you. I've got young adults now that were kids when I started with you. And you know what? I'm excited about that. Happy to have lived through that generation with you. I'm with you. I have grandkids. I have a grandchild now too. But here's the thing, is that there's a lot of new folks in here that follow us just with seasonal patterns of stocks that made the jump and said, I think I want to try out this option thing. And this sounds like a good way to go. And it really is, especially if you are a stock trader. You're going to migrate over to this very, very easily. But let's talk about the 3 definitions and what we're going to be looking at using. So there's in the money, out of the money, and at the money options. And in the money option is an option that actually has real value. To me, if you're going to buy an option, if you're going to buy just a call option, and you really are focusing on something that could be a slow burn to the upside. An in the money call option, although giving you more price risk, could also come with a lot, with, again, less time risk, a lot less time risk. So that's one thing. The out of the money option doesn't have real time value. And this is something that I don't believe I've ever bought a deep out of the money option with all of you in the room, because I detest them. In fact, I do the opposite. I want to be on the sell side of that out of the money option. And a lot of times you'll see me do that as part of maybe a spread, a directional trade. At the money options, I do trade them. I usually end up buying them as part of a spread in a lot of cases. The only time I would buy an out of the money option on its own is if we are working with a momentum trade. For instance, gold and silver were momentum trades late last year, early this year, where they've broke out to new highs, and it made sense to take those ETFs and leverage them with at the money options. But for today's purpose, we're going to be using one of these, the out of the money option, but we're not going to be the buyer. We're going to be selling what I call that junk to somebody who's interested in buying. All right. So when we build a risk graph, this is the first thing, the first element to understanding what we're doing here over the next 4 weeks. Understand that those of you that are stock traders, if you're building a risk graph, let's say you're looking at long 100 shares of whatever, and it's at $20, you're going to be set up very much like this. Your risk graph means that anything below 20, you're in the loss zone. Anything above 20, you're in the profit zone. Okay, where are you at if you're at 19, like I have on the screen here? If you're at 19, you're down $1. If you're at 21, you're up $1. And so this is a visualization of looking where you are, okay, and corresponding where your profit and losses are. All right, now we're probably never going to look at that again in the next 4 weeks. but this is the starting point. Now, why do I not like being, why am I not a fan of buying cheap call options? Well, I'll get to that in a second, but with a stock, what I just showed you, going out a week, going out a month, going out a quarter, it's about a 50-50 chance between now and a week from now, a month from now, 3 months from now, that stock's going to be higher or lower. Statistically, I'm not talking about greed. I'm not talking about fear. I'm not talking about supply and demand. I'm talking about just pure statistical probabilities. Now, when you go out further in time, the stock market on average gains what? Since World War II, it's like 11% a year, maybe 12 now with what's happened in the last couple of years. But let's take that average 12% a year on average with all the dips and all the run-ups. So longer term, you get a year farther out, then the market will skew to the upside. But when you're inside that 3-month time span, that statistical probability of 50-50 is pretty close. Now, trading call options. We know that's the right to buy. We know that. We know it's a set time, no obligation. Buyer pays a premium. Now, if we're buying out the money or out of money calls, time decay often becomes our enemy, because the only way we can really be right on a call option we buy is you have to have the ability to sell, or at least sell part of it on the first initial move. Because if you're sitting there waiting for a move, then time's not going to wait for you. Time's going to keep on ticking, and it's going to tick against you. And knowing that, gives us that at least the first inclination that maybe if I did the opposite of that, I could be on the other side. Okay. Here's where I talk about in the money options versus at the money, out of money options. In the money options that have less time, they decay almost linearly, right? It's a very slow burn because most of the value that's in the money option is real. So, and I'm talking about just time here. I'm not talking about price movement. But with an out of the money or at the money, out of money options, you get in that last 90 days and you're not moving linearly like an in the money. You start moving exponentially to the downside. And that's where, that last 90 days is where the drop comes. So that would look like the probabilities of a roll of a dice. If you have a $20 stock and you've got a 25 call option, you've got 5 points of price movement you got to get to just to get at the money. And then if you get through that, then you're an in the money option. But if you're at 20, your probability is much lower. It's going to be at 25, then it's going to above 25, then above 15. So if we're above, if we just need the stock to be above 15, that gives us a higher probability. All right. So what we want to do is we want to look at bending probabilities to higher by selling puts. So core strategy, one of several we can do, but this is the core. So if buying call options reduces your probability by paying for the option, then selling options would have the opposite effect. Receiving premium increases your probability, but selling calls is not bullish. You can't just say, oh, I'm going to sell the call. No, selling calls, you're doing the opposite of the call buyer. So, and plus, if you sold calls, the amount of margin you'd need to sell something that you don't own or you right away, that's a high hurdle. No, we want to sell puts. So think in mind of this. Buying calls, bullish, because you have a right to buy the stock. Selling puts is also bullish because you're obligated to deliver that stock in case it actually goes lower and someone who's buying the put for protection decides they want to exercise. So think of selling puts and buying calls. They both have a positive delta. They both are looking for a positive outcome. The difference is that buying calls, you need to have a greater than today positive outcome. Selling puts, you could have a less than today outcome and you can still make money. That's where the probabilities come in. So what the core strategy I do is I sell puts. It obligates me to buy the stock if the buyer exercises his or her right. We get paid a premium for that obligation. And this over time is an incredible wealth building strategy. Now, I don't want you to take my word for it. I want to show you the email that we got recently. This came in, and this is from a gentleman named Andy. And so Andy was just telling us, let's see if I can bring it up without giving away his full name. There we go. Just want to give you a bit of my success story. He says, use your TTR service for selling puts based on the training I received from your staff. Awesome results. And he put everything in here. He showed everything he was doing. And then over here, he had all of his profits and his one loss. So pretty cool. So anyway, I thought I would share that with you just to give you an idea of what somebody else is doing, all right, what someone else was doing with this particular strategy. So I find it very cool that someone can take something like this and put it to use for themselves. And this is what I want all of you to do. And again, I'll get into more details. We get to the end of this program on portfolio management and risk management, et cetera. But the core strategy is basically the very, very core strategy. And we're going to trade off of this in weeks to come, making a mini strategy, making a synthetic strategy, making a strategy that rotates month after month. But it all starts right here, the core strategy. So I thought what I'd do for all of our new folks here in the very beginning is let's take an example of something we all well know, okay? This is not a trade alert or a trading example. This is an example to get your beak wet, as they say, all right? We're going to wet our beak with the S&P 500 ETF. Now, I pulled this yesterday, so, obviously the price has changed, but this is just an example. Here's the stock chart. And then again, look at this. This is the past month. It's pretty much gone nowhere. In fact, it was down 72. It's up 68.68 today. So it really is break even between where this month started and where this month ends as of right now. But again, just a starting point. We could, if we like the S&P, we could buy the SPY. You could buy calls, or you could do what we're going to look at as selling puts. So to sell a put to open, what you're doing is you're going and finding the strike price that you are interested in selling. I just brought this up on the Robinhood account just to show you how you would go in straight from I want to sell a put to selling a put. Now, that's not exactly what we do, but I want to skip what we do just to get to the portion of looking at probability. All right, looking at not probability, but looking at actually placing the order. So we're looking at placing the order, and we see here that this is the 687.74. So you have the 688, you have the 687s. Let's go through these. So this is a March expiration. So if I were to sell put, all right, as I put it on here, and I were to sell a 688 put, for instance, then I'm going to receive $11.15 per share for that put. Now, a contract is good for 100 shares of stock. So you have to take this number right here and multiply it by 100, and that's the credit that you're likely to receive. If I sold the 687 put, which is out of the money. So this one's slightly in the money, all right? We call that the at the money option. It's that close. But the 687, the 686, these are farther out of the money, right? So if I sold the 687, I could receive $10.80. If I sold the 686, I could receive $10.46. The farther out of the money I go, the less premium I'm going to receive because we're away from today's stock price. And that's what we as put sellers want it to do. We want it to stay away from our stock price. Okay? So that's the looking at selling the puts. Now, the other thing we can look at is what's called break even. So in this case, if I sold the 688 put and I got $11.15, then the break even, as long as the S&P is at 676.85 or higher, I am at break even or better by the March 20th expiration, right? By the March 20th expiration. And then look at so that's a 676 break even. If I sold the 687 and I were able to get 1080 for that, that's a 676.20 break even. Here's the 675.54 break even. If I sold the 686 put, I have a farther away that this needs to be at. You know, it could pull back all the way to 675.54 by expiration, and I would break even. But I'm only going to receive 1046. Like I said, it gets less and less. So a couple of things that we need to know right away. What's this going to cost me? It depends on the type of account that you're doing, okay? If you're doing what's called a cash secured account, that means that basically you have the cash in your account to buy SPY. You just elected, instead of buying 100 shares of SPY, I'm going to sell the put option. I'm going to bring in some cash. But if you were to buy SPY at that price, you'd be at, for the 687s, okay, is what I'm looking at. I took the one in the middle. The 687 would be $68,700 because that's how much it costs to buy 100 shares of a $687 instrument. All right. In a margin account. Now, a margin account, think about a margin account in the stock market. What do you need in a margin account? Not all the time, but on average, what do you need in a margin account is roughly half. You know, it's called 2-to-1 margin. That means that the bank or the broker puts up $1 for every dollar that you put up to buy the stock. Here's where the bank ends its partnership with you. If the stock goes down, you know, by half, they're going to call back their loan because they don't want to be exposed to the loss. They're happy if you take the loss. They're not happy if they take it. Right? That's what's called a margin account. But if you were to sell puts in a margin account, a couple of things. I mean, it would cost you roughly half, which would be $34,350 instead of $68,770. It would be $34,350. All right. So what does that do? You know, that allows you to put less out there and still take in the same amount of premium. An unsecured or naked account. Now, this is something that you got to graduate to. I believe this is level 4 on the levels. Level 4, level 5, depending on how your broker, what your broker calls it. They have a level 0. Some brokers level 0. Some have level 1 as their starting point. Anyway, you get up to the levels and you go from buying calls and puts, you know, covered calls, cash secured puts, buying calls, buying puts, buying spreads. You know, and then you get into diagonals and you get into unsecured selling of puts, and then even unsecured selling of calls. So myself, I prefer the cash or margin account, right? But you understand that when most platforms and most companies that have tracking services that track on puts, their software is tied into what's called span margin requirements or the minimum margin requirements. So it's going to go out there and it's going to base the returns on the least amount you would have to put up for that. So whether you're cash secured or whether you're naked put, if I go in here and I say, all right, well, the naked put for SPY, let's call it 20% or 13,740. They're going to take, and then, you know, you might even be able to get away with 13,740 minus the 1080 credit you're going to bring in. That brings you down to about 12,000, you know, let's call it 12,700. I mean, you know, we're getting to about for that month, you're getting into something like 8.5% return on a naked account. But keep in mind, that's 5-to-1 leverage if they're only requiring 20%. So it all depends on, you know, the account size and the leverage size. So for our purposes, we're going to tell you what they are on each so that we don't, you know, we cover everybody. But my personal opinion is I like the cash and margin secured accounts. I'm not a fan of the 5-to-1. Because the 5-to-1 could go against you rather quickly. So we break all that down. That's what it looks like. Now let's talk about returns. You know, because I shared this strategy with you just simply to give you an idea of how puts are written, how you could sell a put. You're selling it to open, and when you sell it to open, you would buy it to close. To close it, you buy it back, or you let it expire worthless, which is what I like to do. That's ultimately my job is to is to let something expire worthless and then rinse and repeat. But what if you did this every month with the S&P? So what we did was we looked at, and this was very quickly, and you can do the same thing too, is I looked at the returns for 2025, just for 2025, but you could go back and look at as much as you want, as long as you have the data. But you got returns for 2025, and then you have the SPY put sell index, which is, it's the put right index. PUT is the symbol. So the PUT index is basically an index, it's a put right strategy that concentrates on selling 30-day put options in the S&P, SPY. So you can gauge it one to the other. Here's what you're going to find out. Didn't surprise me at all. Here's what you're going to find out. For 2025, the SPY put right index returned 9.3%. The S&P returned 17.7%. You immediately go, well, why would I want to do that? Well, because with, again, like Uncle Ben said to Spider-Man, with great power comes great responsibility, right? With the put index versus the SPY, with great probability comes lower returns when you benchmark it against the actual underlying, and the underlying goes up. But it also has lower volatility. So look at Q1 of last year. Remember Q1 of last year? From Inauguration Day to Liberation Day, which I believe was in the first week of April, the S&P was down substantially. I mean, we went from being up in the year to being down in the year. The put right strategy, the PUT index, was flat because the premiums that they were collecting acted as a buffer, right? So keep that in mind. Now, how do we put this trade into the Hub platform? That's what I want to do with you next. So part of the cash flow mastery program we have going on includes a software piece, and so I'll mention this too. And Jay, I might want you to come in here and chime in as well, because there's some people that are hearing Hub software for the first time, and they're getting into it, and they're realizing that where do I go? What's the first thing? They have to sign up for an account. We don't just give them an account. They actually have to sign up for one, right? And they've been cleared to sign up for accounts, all the folks that are here. So what's the process for that?
I'm trying to copy and paste the site URL. It's hub.com/account/login?platform. But let me.
Yeah, you need to put that in.
Type that
I
in
can't
here.
remember that.
No, I got you. There you go.
All right. So Jay put a link out there that allows you to create your own sign up and your own login and password. And then once they're done with that, Jay, what do they do next?
They'll get an email from Hub to verify that, and then they'll get in there and they'll assign themselves their own username and their password, and then they can go ahead and log in from there.
Right. And then as part of the cash flow mastery program, once they have their account set up and they're verified, they will then get the extra stuff that we have, including the sell put scan, which I'm going to talk about next week. But I wanted to stop there because
you don't have it activated just yet. We want to get you in, get the account, get weeks of education, and then when Tom starts showing it, going into the next subsequent classes and such, you should have it activated by then, and then you'll be able to use it. We don't want you having it right now and being tempted to go in there and start using it and trying to put trades on without the education under your belt first.
Yeah, let's build the blocks of foundation first, which is what we're doing. And then from there, we can go in and do it the easy way. It's easier way, not the easy way, easier way. But thank you, Jay, for bringing that up. And so
you're welcome.
At this point, what I'm going to do is I'm going to pop on over, and I'm going to, I'm going to start from a brand new tab. That's what I want to do. I want to bring a brand new tab. So I'm actually going to go into Hub. This is what's going to happen when you log in after you've got your username and password set up. You're going to log in. You're going to go to, put your email and password in. My username is my email. I imagine that's most people's. But once you log in, this is going to take you to a front page. And the front page is what's called the dashboard, right? Now, the other thing too is that I'm not going through an entire tutorial on this, but I want you to check the link out, those of you live with us, because we have a lot of folks that are not live with us. But if you're live with us, I want you to click on that link I just gave you and sign up for tomorrow afternoon's session. And it's a live session, but it's also going to be on demand, which means if you don't get there on time, no problem. You'll be able to see it when you log in. And this is going to be JP Drysdale is going to be joining me, and he's going to go through all the features that Hub have, including a lot of the stuff that we used to do with Tom's Option Tools and how you would do that in Hub. I want to show you one thing, and that is how to create the risk graph, all right, using what I just showed you. So from here, what I'm going to do is I'm going to move my mouse over. I got the big red mouse with me today, and I've got all these little icons at the top. But if you go to the fourth one over, you'll see something that looks like a chart. So I'm going to click on that, and that's going to bring up a chart for me. And it's going to bring up whatever the last thing you were looking at. I'm going to go and type in SPY. And there's a couple of SPYs because this is worldwide, but I want you to click on the SPY that says NYSE on it. That'll bring up the S&P 500. And then I have a lot of different settings over here. We'll talk about these later. I'm going to talk about them tomorrow. But for right now, I just want the chart itself. So I've got the chart itself set up. And, you know, your chart may not look exactly like mine. There's a settings area here where you can change all the price axis, the way it appears, you know, how thick you want the lines. For me, as I get older, the lines are getting thicker. You know, and then you can set those up and save it, and you can save it where it always comes up with whatever it is you're looking for. All right, but right now, you know, I'm just looking at a chart of SPY. Okay, so in this case, something that I like to use is I like to go in and I'll show you how we do this in a moment. But with SPY. If I want to build an option table around SPY, down at the very bottom, I'm going to blow this up. You see down there at the very bottom, it says options, and it's also in beta. You guys are all going to have access to that option beta. If you don't have it today, you will have it before the end of the week, right? But that options piece, if I click on that, and I'm going to drop back down, I'm going to click on it. It's going to bring up all the option strategy or option tables for the SPY, which is sitting up here above. Now, usually this comes right up, but it may be because there's several of us clicking on it at the same time. But now I have no options available for this symbol. That can't be right. Try it again here. I might have to go into a different version of this. So I'm running off a different server, but we'll see. I think when we all click on it at the same time, that might be the problem. Then I have across the top here too, as I'm letting this come in, I have calls and puts activated. You can look at monthlies, you can look at weeklies, you can look at how many different strikes you want to look at. I can even go in and select different strategies, whether it's verticals, straddles, butterflies, broken wings, etc. But to build the graph, very odd. This is the first time this has not worked for me. I'm going to try it one more time. It literally was using it right before noon, and it was working just fine. I picked the wrong SPY symbol. That's what John said. You know what? Let's just for the heck of it, I'm going to type in Apple. There's Apple. There's Apple options. Thank you, John. That was it. Let's just look at Apple. So if I were to look at Apple and I were to do an option trade on Apple, and here's Apple's, it moves a lot like the S&P. If you see where the price of Apple is today, you go back to the end of October, it's still pretty much in the same spot too. All right, so down here in the option category, when I click on options, I got February options. I've got the weeklies. If I scroll down, I see all the different expiration dates there. All right, so maybe if I wanted to look at like an April expiration, I can click on that and it pops up. Now it's just going to give me the nearest strikes that we're seeing right now. All right, so let me back this off again. There we go. And I can see that the last price I see on the screen is 273. So if I look at the 275s, these are the 275 calls on the left. And notice that when I mouse over them, I've got green and I've got red. What's the difference? The green or the red is the bid. That would be if you were to sell it at the market. And the green would be the ask, which is if you're buying at the market. So let's just look at Apple for a moment. If I want to sell put on Apple, and I want to sell the at-the-money put, if I just simply click on, in this case, I'm looking at the April 17th, 275 put. Click on the 1105 there, and that's going to bring up my strike price and the details. The option details are going to come in right beside it. There they are. Sell to open, 275 put with the April 17th expiration. That quantity -1 is just a confirmation that I'm selling. All right, it's showing me the price of $11.18. So $11.18, $1,118 comes in. Now take a look at the risk on this. The risk is $26,381. That is a cash secured risk. Profit, the most you can make is what you bring in. So it's got all the details right here. And then I can go in and I can change this. You know, I have a bar over here where I can actually look at the bid and the offer, and then of course what's right in the middle. So we have that right in the middle there. I can, and we're gonna, like I said, I'm gonna let JP get into more details of what this can do. Exits, adjustments, you can save trades. This is all part of the new program. I'm not going to extinguish his thunder. I'll let him discuss that more. But I have a put option here. Where's my risk graph? My risk graph is right here where you see the word risk curve. You would click on risk curve, and that brings up the risk graph. Does everybody see the risk graph? Now, if I move over here and I click and drag, if I drag down, notice price is dragging down, but look what else is dragging down. Risk curve's dragging down. The other thing is if I click and drag in the risk curve, I can move the risk curve back and forth. And if I go in here, and I use a track mouse, but I think if you have a mouse with the little wheel on it and you spin the wheel, it actually can expand and contract the window, right? The other thing I can do is, let me open this up a little bit more so you can see it. All right, so what you see here is you see all of the expirations. You can go in and turn those on and off right down here. Let me try to expand here. Oh, that's not letting me expand. Let me expand from this point. Nope, can't do it there either. Give me some expansion. There we go. 51 days, 38, 25, 11, 0. Those you can toggle those. So like if I say, just show me the risk graphs of today, I can get in here and it can give me more information on those risk curves, right? And when I do that, what's happening is, what's changing is, I'm sorry, not up here, the values are changing. So the values could change based on today's stock price. So it's kind of like a what if. So if I looked at, well, what if this is 0 expiration right here, value 0, but again, 51, here's my value wherever I have my risk graph pinpointed. As we get closer and closer to expiration, the value drops and drops. That's time decay dropping. All right. So again, some things you can look at, but that's the risk curve that I'm sharing with you for our core strategy. Okay. So that's the core strategy risk graph. Now I applied that to the SPY, and if I put the wrong SPY in, let's do that one more time. SPR 500 ETF. Okay, there's my ETF. I've got some other stuff on here. We'll talk about putting on different types of technical analysis in the future. But yeah, I must have had the wrong option piece. But same thing will happen with any stock or ETF that has options on it. Google, Apple, you name it. But I started with the SPY because I wanted to share with you real quick how you put this in, how you would put in an actual short put, okay? So the big question is, how do we improve the results, okay? And I just showed you one example of improving results, because if you sell an at-the-money put on SPY, at the money, you're bringing in, what, 1.5%, 2%, less than 2% for an at-the-money option, okay? And what does an at-the-money option have in terms of probability? The probability it's going to be at break even or better, it depends, but it's somewhere around the 60, in the 60th percentile, which means that you have a 40-something percent, or anywhere from 30s to 40% chance that you're going to have a loss. You might have a 60% chance you'll have a profit. How do we improve those results to 90%? How can we improve our results to 90% and not have less ROI? Well, we can do that a couple of different ways. How do we improve our results? Number one, we can increase the contract size. That only increases the returns. It doesn't increase the ROI. All right. You change to a margin account or unsecured account, that could increase your ROI, but increases your risk as well. And that's something that, we'll have a deeper conversation about later in the month of March. But what we're going to start with is number 3, create a stock system with high probabilities, low costs, and high reward to risk ratios. Now, the reward to risk ratio that most of you are used to is if we buy a call, or if we buy a call spread, we look at selling half of that in some cases at a 50% return. We'll sell half of it at 100% return, depending on whether it's an ETF or it's a stock. But keep in mind, those come with low probabilities. So you can have a high probability setup, or you can have a high profit setup, but you cannot, in almost every case I've ever seen, you cannot have both. You get one or the other, right? This is a complementing strategy to the high profit strategies that we do. But I am going to show you how you can increase your profit potential and decrease your cost potential using this particular example, okay? All right. So let's talk about an example that we used not too long ago, all right, with a company called Rocket Mortgage. So Rocket Mortgage, we know what Rocket Mortgage does. They do loans. And so Rocket Companies is part of Rocket Mortgage. And at the time, the stock was up about 47%. This was late last year when we looked at this particular stock. So this was an example of a stock that we found above average put premiums in, also call premiums, but above average premiums in general. So we saw that, right? We looked at the projections. Now, what I do is I look at initial projections if I were to buy the stock and compare it. Well, first, I'm going to get paid $1,000 to buy Rocket Mortgage 18% below the market price. So this is already looking good just from a standpoint that someone's going to pay me $1,000 to buy Rocket 18%. If I buy 1,000 shares at $15 a share, and it were to return to its previous levels of 20, okay, we're talking about a 33% gain. Then I'd have $5,000 on the stock, plus I'd have $1,000 for original payout. Now, what would have to happen for that to occur? Rocket would have to come down. I would have to get assigned, and they would have to go back up. That's a low probability event. The high probability event is that it never goes down to $15 a share, and I keep the 1,000, okay? And the 1,000 off of 18% on a cash secured account is quite a high number. I'd venture to say that's over 5%. It's about 5.5% during that particular time. So there's a couple of different ways that we can attempt looking at this. Here's the probability graph we were looking at with Rocket, right? this was a 3-month, 90-day trade. And we were looking at, in this case, looking at this particular option at 29 cents. This is the $12 option. Went down lower, got a lower return, but got a higher probability instead. So we use something called probability cones to help us spot what we call the buy zone, that 90% or better zone that the market's likely to stay ahead of. What we do is once we get that, then we're placing that order, right? I did this in the last Cash Flow Mastery event with everybody, and we were able to find a $12 put and get 30 cents or better on that particular trade. And that trade actually ended up expiring worthless. And so let me stop for a second. I want to take us back, and I'll take us back into, let's go to RKT. Now, this is looking at RKT today. So there's Rocket Companies on the New York Stock Exchange. Here's Rocket Companies. Now, Rocket Companies, look what it did. It went to 20, 23, 24. It's come back down to 17 since the beginning of the year. Literally in the last 5-6 weeks, we've seen a drop, right? A couple other things. One of the tools that we have in here is an implied volatility tool. Look at the implied volatility sitting right on top of the chart. Now, this is an average implied volatility, but you can see where its lows are and you can see where its highs are. And it's just coming off the highs that we see here. And then I have the options that are below. Let me blow this up so everybody can see it. There you go. Ben, how's that? So now we have, again, calls on the left, puts on the right. This is the February 27 options. I'd probably want to go out to March or April at the very least. If you look down here, there's our April 17th. Let's open those up. There's our, see, that's how fast this is supposed to happen. And then 6 strikes might not be enough, right? So why don't I go out there and just give me every strike. Give me every strike that we have.
And then when you can, Tom, reiterate for Joseph where you found the probability tool.
I'm going to show that in a moment. I haven't shown that to anybody. It's called volatility cones. It's a setup. It's a setting or it's in one of the tools and studies of Hub. I'll show you how to get that in a moment. But what we're doing is we're coming in and looking at the strike prices right now. And so what strike do we pick? All right. Your timing couldn't have been better, Jay. What strike do you pick? Well, one of the ways we analyze that is by looking at the probability cones on the chart. So I have there's a little button here that I have. It's in my favorites, and it's called VLC. But let me show you where you'd find it. If you come up to Tools or Studies, they're off the same tab. See, one tab is Studies and one tab is Drawing Tools. And under the Studies area, you're going to find studies that say volatility and volume. If you click on the volatility section of the studies, right there, you're going to see historical, implied volatility is going to be in there. You're going to see VLC, volatility cone. Now, what I have is I clicked on the stars and they became my favorites. And when they become your favorites, they sit over here where you can access them at any time. I've got, Elliott Wave, I've got the MACD, I've got AI, which we're going to be discussing in another mastery program. But then there's moving average convergence. I've got moving average convergence, divergence. I've got pitchforks, and I've got different areas of Fibonacci's. This is a time and price projection tool. We're going to show you how to use that tomorrow. And then there's my volatility cones. So let me just cancel this. Because it's in my favorite, I'm going to click on volatility cone, and look what happens. The cone comes up. Now I have my settings for my cone, and I'm right and clicking on this to open up the volatility cone settings. Volatility cone settings, I have my projection bars at 20. So,
and if I may interject, Tom, folks, you're at like an hour and 6 minutes into the session. So if you write down on a piece of scratch paper somewhere, 1 hour, 6 minutes, you can go right to this, pause this. When he blew that up, have those settings, enter them in if you want to have them duplicated as Tom's do. Thank you,
That's
sir.
right. That's right. That's right. Okay. So what I did was I blew this up to 30 days. So I'm going to put this at 30. And then I have my standard deviations at 1. I have my volatility source as historical volatility. And the field is closed. So this is how I have everything set up. If I go to appearance, I have the 68% and the 95% both check marked, and I have the fill check mark. And then because, I'm an old guy, doesn't see as sharp as he used to, I put my axis at 2. And so once I did that, I'm going to click on defaults down here at the bottom. And when I click on defaults, it's going to ask me if I want to save this as defaults. That's the bottom piece. I'm going to click on save. This will save the settings as current defaults. Do you want to continue? Yes or no? Click on yes, and I click OK. And now I have my volatility graph set at this particular setting. Right? So you know what this is telling me? This is telling me this is the area I like to put, I like to be outside of the blue cone, the inner cone, and somewhere inside the red cone. So I'm not the red cone, the lighter blue cone. So if I'm looking at this, I am immediately looking at maybe the 1250 puts. That looks like a good buy zone. When I say, well, what put do you sell? I want something that's going to be in that 90 percentile area. Now, this does not include the option premium, because when you add the option premium in, that gives you your break evens even lower. So let's
your volatility cone box is still up on the view of the chart there, Tom.
Yeah, it should be.
Okay.
What do you think should be up there?
I thought you were emphasizing the cones underneath the volatility cone box.
No. I'm looking at option strikes now to determine the actual strike price. Okay. So if I'm looking at the cone and I'm seeing the bottom of the cone, I don't look at the top of the cone. Top of the cone is, I'm looking at where would I buy that stock. All right. Let's look at 1250 first. So if you notice right now, my options, this is options that expire tomorrow. All right. No, in 2 days. 2 days. I don't want those. I'll close those up. I want options that expire. Here's April. So let's look at April and see if there's anything in April. So I'm going to open up the April options. All right. Where's my April options? Jay, can you still hear me? I'm wondering if it might be up there. They are.
I can still hear you.
Okay, great. So I'm looking immediately. Yeah, I'm looking at these immediately. I'm like, I may have to go out to May, because down here around 13, it's 26 by 35 cents, and that's not bad. That's actually not bad. I mean, it's close to what we did last year with those out of the money options. But let's go out instead of something that is 28 days to expiration. See here, it shows. Okay, let's go to the May 15s. Open up the May 15s, and then I'm going to look over to the right-hand side. And then I'm looking right in here. So here's the 12s. Here's the 13s. 47 by 73. That's that $12 option, 30 by 37, that's got some liquidity in it. So I'm going to click on the 30. And notice when I clicked on the 30, that's as if I were looking to sell this option. And it's giving me the mid price, which is 34. Okay. But here we go. It's already set it up. And as you can see down here, there's that $12. This is where the stock is right now. This is where it has to come all the way down before it starts, before it becomes a problem for you when you get into expiration. But if we wanted to look at this a little bit differently, remember I told you I could click and drag this back and forth like this. All right, let me show you what else we could do. You come to the numbers, start at the top, click and drag down. It'll squeeze the chart together. Notice up, down, it squeezes the chart together. Gives you a better idea what happens below the strike price of 12, 11, 10, etc. There you go. All right. So that is Rocket Mortgage, and that's an example of one, all right, that we could look at as a high probability trade. So it's a high probability trade. This is about a 90%, this is right around 90% probability. What are we looking to get out of this? We're looking at 30, let's take the mid price, $34. on a $12 strike. So 12 times 3 is 36. So this is a little bit less than a 3% return in the next 2 months. Less than 2 months, 3% return. That's cash secured. That'd be about a 6% return, margin secured. And naked, what you do is you take the cash price, the cash return on investment, multiply it times 5. So 3% be 15. Be a 15% return on the naked side. All right. So now it's just a matter of verifying that order. Okay. Verify the order. What we do is I'm going to bring over my RKT, bring over my trusty options platform, and we'll look at Robinhood. And let me bring it into view for everybody. There we go. All right. So what we're doing now is we're going to verify that this is something that can be had. So again, sell, put. Make sure I'm still being seen. Yep. Sell, put, and then I'm looking at. Let me blow this up a little bit more. We got that way I can see the option prices. All right. Here's my option prices. This is February, but I want to look at the Aprils. There's the April 17th, 51 days. All right, let's go down. 16, 15, 14, 13, 12. Okay, so the 12s are only 22 cents today. Wait, was it the Mays we were looking at? Yeah, I'm sorry, the Mays. May 15. That makes more sense. 12s. 12s are 36 cents right now. So let me click on that one. So I'm going to click on that one for a moment. I really want to open this up because I want to see some details. 34 by 39. So it's got some, you know, it's decent. Only seven volume, but I don't look at volume and open interest. I look at the difference between the bid ask at the time. So this is one where this could be a 35-cent trade right here. All right, 35 cents because you're well outside the middle there. So, you know, how do I take a trade like that? Well, you know, I'd come in and if I click continue and I decide, you know, it says a medium fill likelihood if I were to look at 36. If I went to 0.35 and put that in, it's still showing a medium fill likelihood. But, you know, again, and what you do is you size this up because I'm doing this live in class. I'm going to do one contract. That way nobody is going to accuse me of front running or anything like that. But I would come in and I'd look at Rocket and verify everything. I'd look at the 30, you know, my bid and offer. I'm actually going to hang out, wait on this for a moment because that way I'm definitely not going to be accused of front running. If anything, I'll be accused of back running. So at this point, Jay, let me bring you back in, or at very least on audio. And did you see any additional questions, especially any questions on placing the order?
Not pertaining to placing the order, navigation of the software, or any of the education. I've sent you an email regarding some of the concerns regarding feed and that type of stuff. We can address.
Yeah, I do see if I turn my camera off, maybe that might help as well.
Yep. But other than that, no, solid session, and it looks like everybody's tracking well with that information and the education provided.
Okay. All right. Yeah, and you know, like I said, this is you know, things get better. All right, things get better from the core strategy when it comes to cost, when it comes to risk and reward, and when we also get into return on investment. All right, we start looking at synthetics. The return on investment's going to go up. In fact, it has to go up or I won't do it. Okay. So from here, you know, if I find something I like, I'll go ahead and review the order. Click review order. Then it's going to give me, you know, one more chance. Hey, take a look at this, and this is what you're agreeing to. Blah blah blah. And I'll go ahead and submit that. And then the way I know if it gets filled is what just happened. That 0/1 just became a 1. Okay. So that's now part of a portfolio that we'll follow. You know what I'm going to do too? I'm actually going to put this in because now I even know what it got filled at. So I'm going to go ahead and put this one in. Oh, look, now it's 36 by 39. Shame on me. Now I can get it for 37 cents. So what I'm going to do too is I'm going to show you all exactly how we put something like this in. All right. In order to do that, though, I'm going to need to grab some stuff real quick. So I'm going to grab this. I'm actually taking a quick little snapshot, and I'm going to add a little bit of commentary, very quick little commentary up here. Sell to open, RKT, May 17, $12 put. Limit 0.35. There we go. All right, now I'm going to name this RKT CFM for cash flow mastery. Perfect. All right, let me show you how this whole thing comes together. So when we research stuff, and trust me when I say researching something on my own is a whole lot easier than researching it on the fly with everyone watching live. But I have, we have the editor portion of this, so I can go in and I can immediately add a trade. And what I'm going to do is I'm going to select our cash flow mastery course. And the strategy I'm going to select is a short put. And I'm going in and looking at RKT. There's Rocket Companies. We are selling the May. Oh, it's the May 15th. I said May 17th, May 15th. My bad. I got to make a little fix here. May 17. What am I thinking? May 15th. Okay. Let me save that real quick. Gotta save it. Okay. There we go. So back again. May 15th. $12 put. And I like this at 35. So I'm going to put in here cash flow mastery. Trade number 1. And that's a 35-cent credit. And I'm going to preview this trade. Now, again, you can't do this. I'm just showing you what we do on our end. But it just shows you, what the things we go through to make something, available. And so this is just going to the cash flow mastery students. So when I do this, I'm going to go ahead and I'm going to confirm and send this alert. Now, all the partners that are with me for the year and all of my cash flow mastery members who signed up over the last week are going to get this. You should get this by email, and you should, or you're going to see it on the dashboard. So again, this is just doing some verifications right now, and this is going to go out here shortly, and then I'll get a little green thing across the top saying that it's been recorded, it's been logged, it's been sent, and so that takes a moment there for that to happen. And while that's happening, let's see what we have going on. Yeah. Oh, so there we go. There's my successfully sent to the cash flow course. So what's going to happen is you should be able to see under your dashboard, under your cash flow dashboard, you'll now see that alert that's right here. It's popped up. Right, cash flow trade mastery trade number 1. And then it's blurry only because I'm dialing in. When I come back like this, it's not so bad. Then you can actually click on this and you can see the actual trade itself, and you can get any other commentary. I usually put more commentary there than just cash flow mastery trade 1, right? But that's the short put. That's now in the trades, and then under the trades, if I go to the trade list, I have all kinds of trade lists here, but let me go to cash flow. There's cash flow mastery course. Let's go to open. And there's our Rocket. There's our Rocket Mortgage open trade right there. Now we have trades on, I put 2 trades on last week. This isn't really trade number 1. It's trade number 3 because I put 2 trades out on USO last week, and somehow, and it might've been me, they ended up expiring already, which we know they didn't because they didn't expire. So we're in the process of getting those put back in. And if worst case scenario, either we put them back in or I'm just going to recreate them, and I'll make sure that they're backdated with the time and price stuff that we have. But those will be back in on the screen here by the end of the week. But that's our open positions. And then you're able to see the winning trades. Now, this includes the last cash flow mastery trades we did from last year. We didn't have a single loser. But then you can see that by going to the closed losing positions. Boop, none. All right. So that's how we publish a trade and get the trades to you, not only in cash flow mastery, but in our regular trade alert services as well. All right. So we are at a stopping point, guys, for week number 1.